Thank you so much. I'm excited for today's presentation. We're going to be talking about the #1 trading strategy for the summer. My favorite strategy, tested and approved, which means we've done a bunch of tests. I'm going to kind of walk you through them, walk you through the results today, how it works, and let's go ahead and get this party started. So our objective today is pretty simple. What we want to do is we want to find the best strategy that's going to make us the most money so that we're not using strategies that are just going to make us a little bit of money. We really just want to make the most amount of money with the amount of time that we're going to spend trading. So the kicker is we want to do it safely and consistently. Safely means the risk reward is good. We don't have to risk a lot of money or risk too much. Consistently means we want a strategy that will work over and over and over again so we can continue to milk it. Now, how do we do this? We're going to do this by finding the best strategy, and to do that, we need to backtest the most popular indicators in strategy to see, well, which one wins. And so here are top 3 strategies that a lot of people are using right now. We're going to cover them. The first one is going to be the stochastics cross. Actually, let me go back here. This is the stochastics, this is the MACD, and this is the payday cycle strategy. These are 3 strategies that are really common, especially the first 2, stochastics and MACD, are probably the 2 most common indicators, apart from maybe the RSI or the Ikemichi cloud. But we're going to start with the stochastics today. I want to give you a quick overview of the indicator, how well it's performed, everything like that, and kind of give you the buy and sell rules that we use for it, and how well it's performed, and maybe how you can leverage it. So the stochastic cross has pretty simple strategy rules. We're going to use a really simple default 14-day stochastics cross to the upside. What that looks like on your screen is basically when you have the 2 lines, very simply, the 2 lines crossing. You can see I have a little buy and sell box here highlighted for you. And so you're going to buy when that crosses to the upside, and simply you're going to sell when it crosses to the downside. Now, the interesting part about the stochastics is that it's a very fast indicator, which we'll cover here in a moment. It's a very fast indicator, which means it only lasts 3 or 4 days. So if you want a fast trade, if you're somebody who wants to trade once a week or maybe twice a week, this could probably be a good indicator for you because it happens so fast. Okay, so when we actually look to backtest the stochastics, we're going to use the Wall Street AO platform. This is a platform that my team and I have built to make it easier for our traders and our family and our friends and members to be able to backtest indicators and strategies really quickly. And so to backtest the stochastics, we're simply going to click on stochastics from the list of indicators. It's going to load up in the buy and sell ticket here, the 14-day stochastics, which again is just the simple one. And when we do that, we have a whole results panel here that shows us how well it's performed, when you would have gotten in and out, the risk reward, batting average, how often it happens, everything like that. Now, the advantage of using something like the stochastics, again, it's a very fast moving indicator. The average days is only 4 days. So you're going to have a lot of trades throughout the year. In fact, when we look at this happens about 47 times a year. So you can think like, wow, that's a really, really active strategy, more than, almost once a week, basically. Now, one of the disadvantages, though, of the stochastics is that the low batting average, you can see the low batting average being at 48%, means that the strategy is a little less profitable. Now, it's still profitable, so it'll still work, and that's largely because the risk reward is really good. At 1.7, it means that you'll make, on average, about $170 for every $100 that you're risking. Now, the low average days also means that from time to time, you miss the second half of a move, because if a move lasts, let's say, 7 days or 8 days, and you're only in it for 4 days, you could be leaving a little bit of money on the table. So that's a little bit of the disadvantage. But hey, stochastics, for many stocks, Apple's the one we're testing here. It's my favorite stock to trade, is a very profitable strategy. In fact, you can see these little green histogram bars being green every single year here means that this strategy has been profitable every year for 10 years. And each one of these represents 1 year. Now let's go ahead and just jam on a few of the actual data points here of the stochastics. And I'll stop for a second after I do this and take any questions that come up. You'll find that I really love interactive webinars, so if you do have any questions along the way, feel free to just go ahead and ping me every couple of minutes. I'll stop and take a look at them, and then we'll probably have time for a Q&A at the end. Okay, so when we look at the stochastics altogether over the last 3 years, we got about 141 trades, pretty active strategy. The batting average is so close to 50%. But again, that's not what makes it profitable. What makes it profitable is the risk reward is really good. You have a 1.7 risk reward, which means it's almost 2 to 1, right? And that's what makes it profitable. But the kicker is the average win length is only 4 days. So if we're to take all the wins out of the 68 wins over the last 3 years and average out the amount of days that you're in the trade, you get 4 days, 4 days in the trade. So it's a very fast strategy, right? Again, the average gain is a little over 2%, and the average loss for stochastics is just over 1%, about negative 1.25. And this relationship right here is what generates such a good risk reward. So you can see again the average gain being over 2, and the average loss being just over negative 1 or 1.25 means that you're going to be making a lot more than you're losing when it doesn't work out. And again, the win length being 4 days means that it's going to be a very fast strategy. So that's a little recap of the stochastics cross. I like stochastics, but I like the next indicator better. Let's go ahead and talk about strategy number 2, the MACD cross. So quick overview of the MACD. MACD is a subchart. Probably most of you are familiar with it. I like the MACD because it's generally a little bit of a longer indicator, which I'll show you here in a second. The rules are very simple and very similar to something like the stochastics. We're basically just buying when the two lines cross. With the MACD, you've got a fast line, which is the green one here, and then you've got a slow one. Just like with two moving averages, if you have a fast one and a slow one, the fast one will follow the stock a little bit closer, and the slow one will follow a little slower. So when the fast one whips up and above the slow one, you've got a buy signal. In this case, we're using just the default MACD, which is 12.26.9. And when it crosses to the upside, you can see here, I've got it highlighted for you. You can go ahead and buy. When it crosses back to the downside, you can go ahead and sell. Pretty simple rules, okay? Let's go ahead and talk about the backtest of the MACD. Again, we've got a bunch of really great indicators that we could backtest at Wall Street AO, like ADX, DMI, any moving average, MACD, moving average crosses, the PayDay cycle, RSI, stochastic, stuff like that. So in order to backtest the MACD to get these results to see, well, how well has this worked? We go ahead and just click on MACD. It loads up the buy and sell ticket here that we can analyze. And again, we're using just the 12.26.9 for our MACD. So some of the advantages of the MACD is it's got a really, really great risk reward and batting average, which gives this strategy a little bit of extra profitability. And the other advantage is that the trade length captures a longer month-long trade. Rather than a stochastics, which is like 4 days, this is going to be more like a monthly trade. So you can think there's probably several stochastics crosses in one MACD cross. The disadvantage, though, is that it's a little bit slow, right? And that's partially why it's so long. The slow-moving MACD might give you a slightly late entry and a late exit point, but you're still going to capture the meat of the move. Let's talk about the actual data points here for the MACD. So when we look at all these data points, there's a few things that come to mind right away. The average gain is insane, over 6%. And I don't know about you, but if I get a 6% move in a stock on a swing trade, I am so happy with that. So an average gain being over 6% and an average loss being under 3% generates a beautiful risk-reward relationship. So you can see the risk-reward here is actually better and higher than that of a stochastics at 2.2. And again, this is generated from this average gain being over 6% and the average loss being under 3. So think about this for a moment. If the average gain was 6 even and the average loss was 3 even, you'd have a perfect 2 risk reward, if that makes sense. I'll go ahead and stop in just a second and take any questions. If there are any questions about these first 2 strategies, we're going to spend a little bit longer on the third strategy because, well, that's the winner, and that's the one we want to use a little bit more often, but it's good to kind of recap some of those popular ones so we can see, hey, which one actually does win when we look at the raw data for it. The other thing is the win length at 20 days. These are trading days, not calendar days. So I figure about 22 trading days in a month. So at 20, you can just expect that the MACD will last about a month. So how can you use that information? So if you're a stock trader and you get in, to a MACD cross, let's see, today being June 8th, and it lasts a perfect month, then you can expect to get out of the trade around July 8th. So you can help set up, that'll basically help set up the expectations for the trade. And knowing the average gain will help because, hey, if you're trading, let's say, a $200 stock, and you know the average gain is 6%, then you know you're looking at about a $12 move. And that can help you set up profitability targets. The average loss, well, if you know the average loss, then that'll help you set up stop targets, but it'll also help you position size. We're going to kind of go into that a little bit deeper on the next strategy, but just start to think about how you can use this data to get some really, really good trade expectations. So I'm going to take some questions here just real quick to see and make sure everybody's up to speed. We got Art. Strategy, does it work on forex? We currently don't have futures or forex. We have Amex, NYSE, and NASDAQ. We cover about 8,000 tickers. Curve fitting would be more like if we wanted to say, hey, somebody says, hey, isn't backtesting just curve fitting? Curve fitting would be more like we would say, hey, let's take a moving average cross and continue to change the permutations of it until we find the perfect fit. That would be curve fitting. What we're doing is we're simply looking at the most popular indicators and saying, hey, how well do these perform with a default basis? And the more generic, actually, the better. And that makes it so that we're actually avoiding curve fitting altogether by using a generic strategy. But good question. All right, let's see. Okay, another one for day trading. Cool. Good question. Good question, Gillian. We're going to answer that here in the next strategy. Stephen wants to summarize the stochastics data points a little bit more. The biggest thing that you're going to be looking at is the average gain and average loss and win length. Those are the most important things. Stop losses can be used and measured, good question, by using the average loss. And more importantly, before you even think about a stop loss, you're going to be you could use the average loss actually for position sizing. Okay, Steven says, thanks. Okay, cool. Backtesting, how far can you backtest? We can backtest up to 10 years. I like to use 1 to 3 years because that gives a really nice short-term time frame and makes it relevant for right now. Sophie, what's up, Sophie? Absolutely, you can do ETFs. In fact, we're going to spend a minute or two on the Qs today. I really like the Qs. Ricky says, I believe the MACD advantage should say low risk reward. Nice. So it's got a really, really good risk reward relationship. Thank you, Ricky. Another question, 2 strategies work best on monster stocks. Yeah, we're going to just cover Apple and a few stocks that we know work really, really well. Good question. Ooh, lots of good questions today. This is awesome. Yeah. Do we get out of the trade when the market's falling and get back in when it's rising? That's kind of the idea, but we're going to go through that in a little bit more details. Let's see. Yeah, we're only going to be looking at daily charts since I'm mostly a swing trader. All right, cool. Yep, gaps are included in the results. Good question. All right, cool. Great questions, everybody. This is fun. All right, so let's talk about the winner today. So far we've covered the stochastics, right? Average gain, slightly over 2%. Average loss, just over 1%. So you got a pretty good risk reward. But again, with the stochastics, it's only 4-day trade. And so you're kind of leaving a little bit of money on the table. The opposite on the MACD spectrum, right? Where you have a longer trade, it's about a month long. And you're capturing this huge move generally, over 6%. And it has a better risk reward and a better batting average than the stochastics. But one thing, actually, is that the MACD generally only happens about 9 times a year. Remember, the stochastics happens like over 40 times a year. MACD, because it's a longer cycle, about 9 times a year. So you don't get as many trades out of it, right? Now, the strategy we're going to talk about today is called the payday cycle. And a quick overview. The payday cycle is a very simple strategy. And instead of using a subchart or indicator, we're actually just going to use something called the Heikin-Ashi chart. How many people here have used the Heikin-Ashi chart before? That's spelled, by the way, you can kind of see it right here. H-E-I-K-I-N space A-S-H-I, Heikin-Ashi. And the Heikin-Ashi is an aggregate chart, which means it's going to change the way the chart looks a little bit. And it's going to smoothen out the trend a little bit. And what really is nice about that is visually, it makes it easier to see the trends in the cycles. It makes it easier to see directionality. It smooths it out, and most importantly, it eliminates a lot of the noise. What it also does is it gives you really super clear buy and sell signals based on the color of the chart, which is one of my personal favorites. So we'll talk a little bit more about the strategy, and I'll even show you a few examples on a live chart today as well. Now, the strategy rules. This is what I love about the payday cycle strategy. They're so simple. The strategy rules in the very basic format of the payday cycle, and I'll give you a little bit more advanced one in a moment, but in the very basic version of a payday cycle, the buy rules are buy on the first green Heikin-Ashi at the close and sell on the first red one at the close. So you can see here, when we get a first green one, you're going to go ahead and buy. When you get your first red one, you go ahead and sell. Now, the idea here is that you're going to capture these naturally occurring cycles that are already happening anyways. And all of our backtesting is routed to the closing price. So that's what we're going to use to initiate the buy and sells. Now, to backtest this, what we're going to do is we're going to go ahead and click on that backtest tab. And under the list of conditions, we're going to click on payday cycle. And again, what we're testing is buying on the first bullish one, which is the green one, and selling on the first bearish one, which is the first red one. Now, the results of this are pretty amazing, actually. And again, what I love about this is it's not necessarily using a subchart or indicator that's lagging. It's literally using that day's candle in a Heikin-Ashi format to generate buy and sell rules. Now, this strategy has a lot of advantages. The biggest one is it takes advantage of naturally occurring cycles. These things are already happening in a stock anyways. And we're going to give you some examples of that here in a moment. It also gives you clear buy and sell signals based on the color of the chart. It's the best day-to-day directional and momentum gauge. I think it's better than a lot of lagging indicators, which makes this strategy the #1 strategy. The disadvantage, which I'm going to show you how to overcome here in a moment, is occasionally you can have false starts during counter trend setups. So what's a counter trend setup? A counter trend setup would be when a stock is in a downtrend and you're trying to buy, or a stock is in an uptrend and you're trying to short. That would be a counter trend setup, and occasionally this strategy will have false starts, but I'll show you how to overcome that here in just a moment. So let's talk about the results here for a moment. So what's cool about the payday cycle strategy is the average loss is lower than any of the strategies we talked about today. It's under 1%, which makes the risk really, really, really slim. The average gain is almost 2%. So again, with a $200 stock, you're looking at about a $2 to $5 move. One of my favorite parts, though, is the win length at 7 days. 7 days is this magical number, right? It's this magical number in the stock market. We'll talk a little bit more about that. But what's great about that is you're literally capturing the entire move of that cycle. Remember how Stochastics only got you 4 days? And one of the disadvantages there is sometimes you leave a little bit of money on the table because you get out too early. The payday cycle is able to capture the entire length of the move because you're literally using the candle itself to get in and out. All right, so average days in a payday cycle. Before we actually cover this, let's talk a little bit more about payday cycles. And to do this, I'm actually going to jump over to Wall Street AO, and we're going to look at a live chart. I got my dark screen up. I hope that's cool. I like the dark screen. This is Wall Street AO. This is the platform that we use. Let's see if there's any questions here. Yes, yes, yes. Lots of people use the Heikin-Ashi. Cool. All right, cool. Okay, question. Can you buy on the second or third day if you missed the first green candle? So that's a good question, and I get that sometimes. From time to time, it makes sense to get in late. But the biggest thing you have to recognize is when you're getting into a trade late, you're taking more risk. So maybe if you're going to be late on the trade, maybe you take a smaller position, or you just wait for the next one. This strategy happens 2 to 3 times a month. So maybe instead of getting in late, you just keep an eye on it, right? Every single day, spend 5 minutes looking at it, or 2 minutes, so that you're not late on the next one, and then you catch the next one on the first day. Because this happens so often, there's so many trades every month in a lot of these popular stocks. I believe that there's really no reason you should be getting in late. Just keep an eye on it every day. I'll kind of walk you through that a little bit more. Make sure you get it on the first one when the rules and conditions are correct, and that way you're not taking any extra risk, right? The other thing to think about is if you get in on day 3 and the average move, let's say it's $5 and it's already moved $3 by day 3, then really you have a really slim amount of profits left. And so we want to try and capture the most of the profits, okay? Pretty cool indicator. Thank you, Peter. I appreciate that. All right. Yeah, consolidations are tricky. I'm going to show you how to overcome that. Timothy asks about all time frames. Good question. We're backtesting the daily. This, I think, works the best on the daily, partially because I'm a swing trader, so I really like daily time frames. We got another question. What time frame can it be tested on? I like the daily. All right. Can you factor in seasonality? Absolutely can. In fact, if we have a moment, I could cover seasonality information, which is pretty cool. We actually have a whole seasonality suite here at Wall Street AO where you can look at the seasonality of any stock in our database, which again is Amex, NYSE, and NASDAQ. We got about 8,000 tickers and ETFs in our database. And we've got these beautiful seasonality charts if you wanted to use them. Good questions. Carlos. Is there a amount of red candles that need to close before the next green candle setup is validated? Good question. No, I mean, sometimes you only get 1 or 2 red candles before you get a nice green setup. The biggest thing is to think about it's the red candles that set up the green ones, right? So when it starts pulling back and it's red, if you're not in the trade, you should be like really excited because you're like, these red ones are setting up the next green one, right? Good questions. What type of candles are those? These are the Heikin-Eshi candles. All right. Sophie says, why only 8,000? I'm not sure if you're being sarcastic, but for most people in our community, the most profitable members of their community, and if you talk to most floor traders and market makers, they only trade 2 or 3 things. Like me, I only trade a handful of stocks and I just continue to milk them over and over and over again. It's called being a specialist instead of a generalist. For the most part, a lot of our members have a personal trading transformation by going from trying to trade 100 stocks to just trading 2 or 3. And they're super profitable with those. Okay. Lawrence, I'm going to say you hit follow on Apple, but you haven't gotten some notices. Okay, cool. So Lawrence, it sounds like you're a member. That's so cool to hear. It probably sounds like the strategies that you're following have not started yet. So what I'm going to do is say, just go ahead and you can email our support, and we've got some awesome customer support. We are so happy to help you out with that. All right. All right. Peter says this actually works great on the 30-minute. Awesome. Okay, cool. So, all right, lots of questions coming in. We'll have some more time for a Q&A here in a moment. What I'm basically going to do is I just want to kind of review this Heikin-Eshi payday cycle thing in a little bit more detail for you. So again, what we're doing is we're using the Heikin-Eshi chart, different than the candlestick. So here's the candlestick, and here's your Heikin-Eshi. Candlestick, Heikin-Eshi. Candlestick, Heikin-Eshi. So as I kind of flip back and forth, I want you to take a visual note of how these are so different from each other. They have the same data flows in, but it's so much smoother. It's easier to see. But you think about it for a second, and if you want to, go ahead and post into the chat room and let me know, hey, what are the biggest differences that you see? Is it smoother? You know, go ahead and post in the chat room, and I'll highlight a few things that people in the chat room say. The biggest thing, though, is it's smoother. It eliminates a lot of the noise. It makes it easier to see and gives you some pretty clear directionality. One of the other cool things is, for the most part, these cycles tend to last about 7 days on average, which is really, really great. You get the entire move, and there's some metrics that you can use to help you identify when the momentum is going to continue by breaking to the new high, each day breaking above the previous day high. Now, one of the things I talked about earlier that some people were asking me about is, does it get you out when stocks are dropping? And the simple answer is absolutely yes. That is one of the main goals of this. And when you looked at the average risk being under 1%, the reason for that is you will never encounter a big drawdown because you're only going to be in it for 1 red day. Now, there's some even better ways to improve that. Now, earlier I mentioned one of the disadvantages is from time to time you have false starts. So what does a false start look like? Let's go ahead and see. Well, here would be a false start. You got this downward cycle, you got a nice green one, but the green one shows no follow through. So this would be considered a loss, right? False start. You get another false start here. So you get some false starts. So how do we overcome this? Let me go ahead and show you. I'm going to go ahead and open up our backtester. And I am doing this live. I'm going to blow this up a little bit for you for a bigger screen. I'm going to go ahead and load up the payday cycle strategies, just one click. I'm going to click on view stats, right? Again, 31 trades a year, very active. Great risk reward. This is just Apple with a 2 risk reward. That means the average win is about twice as much as the average loss, 52% batting average. Okay, and again, this strategy lasts, the magic number here is 7 days. This is going to circle back around. We'll talk about how important that 7 days here is here in a moment. So how can we improve this strategy even more? I'm always kind of thinking about this. How can I improve my strategy? How can I make sure that the trades I'm going to take are more likely going to have a great outcome? How am I going to eliminate some of that risk, some of the risk factors? More importantly, how are we going to skip over and maybe decide not to trade during times where we're more likely to get a false start like this one? So what I like to do is I like to use a secondary condition. And this is what's called probability stacking. Probability stacking is when you have a strategy that works great on its own, which this one does. Like if you use the payday cycle strategy, it'll be a profitable strategy for you, over a series of trades, as you see here. But we want to make it more profitable. We want to do something that's going to improve and expand our profitability. So we want to use a secondary indicator, so that we need both conditions to be true in order for us to get into a trade. And so what I'd like to use is something as simple as a very common indicator like a 21-day moving average. And so what I'm going to do down here in my results on the backtest is I'm simply going to add a secondary indicator. And what's so cool about the backtester that we built, it's as simple as dragging and dropping. It's basically the only drag and drop backtester on the market. It's so cool because you can drag and drop these conditions in. So the way this now reads is we want to go ahead and buy Apple on the first green bar, but only when the price is above the 21-day moving average. What that's going to do for us, it's going to say, hey, when Apple's in a downtrend and it's below the 21, we don't want to take those trades because they have a higher risk. However, when Apple turns around and goes above the 21-day, hey, that's a better trade for us. And we're okay and we're comfortable taking those trades. Those are not counter trend trades. We want to trade with the trend. Okay, so we're just going to avoid taking the trades when it's below the 21-day. And right off the get-go, you can see how it improves both our risk reward and our batting average. We're going to take less trades throughout the year, but that's the whole point. We want to eliminate trades. We want to eliminate those losing trades. And in the process, improve our risk reward, improve our batting average, everything like that. Now, I want to include one more thing here. When you are developing a strategy like what we're doing here, in many cases, you don't just have buy when this happens and sell when this happens, right? You don't have an entry and a stop. You have an entry, a target, and a stop. So what's cool about this is we have so much data that we can leverage around our target, because right now we don't have a target or profit target in this strategy yet. So we can use these average days around 7. We know that on average, these cycles tend to last about 7 days, right? Now, in many cases, when these work out, they go 1 or 2 days over average. So let's say 9 days. So when these trades really work out, like the most profitable ones will last about 9, sometimes even 10 days. So what we're going to do is we're going to add one more condition here to our strategy. So we're going to buy on the first green payday cycle at the close, but only when it's above the 21-day, right? And we're going to sell on the first bearish one. That's going to keep our risk really, really low. And I'm going to add a second sell condition. This is going to be a for profit sell condition. So I'm going to go ahead and sell. And I'm going to do this. By the way, I'm giving away like my best strategy here, which I love to use. We're going to go ahead and sell if we get 9 bullish days in a row. So what does that do? Well, it basically says, hey, instead of selling and waiting for it to go bearish on us, why not try and take profits right at the top, right at the tippity top, and sell if we get 9 days in a row? The reason for that is it's actually quite rare to get a payday cycle that lasts more than 10 days. So we want to sell right at that 9-day, right at the top. And when we implement this strategy, look at the results we now have. Just take a look at this for a second. This is pretty cool. We now have a strategy that has a risk reward of 3.3. This is substantially better than anything else we've looked at today. The 3.3 risk reward is generated because the average gain is now 3% and the average loss is still under 1%. And I have that information right here. Average gain over 3%, average loss still under 1%. This generates an insanely good risk reward. We've also improved our batting average, and again, we're taking about 18 trades a year, so about once a month this is going to happen, maybe a little bit more. These little histogram bars right here represent a year. Each one represents a year. So what I love about this strategy, when you implement the payday cycle, which is profitable on its own, but remember we added some things to it to eliminate trading during false starts, is that it's been profitable every year for the last 10 years. Every single year, the strategy's been profitable. It's also outperforming the stock. So we created, when we were building our whole backtesting system here, we created this cool results panel that shows you, all this great information about strategy, the trade log, everything like that. But we also wanted to include a little line chart up here. The green line is the strategy, the white line is the stock. So the green line is outperforming the stock. So the strategy is doing better than buying and hold, and that's kind of what you're looking for. But more importantly, when the white line, which is the stock price, when it pulls back and starts to drop, the green line goes flat, meaning you're not trading. And then when the stock starts to go up again, then the green line starts to rise. So notice the green line doesn't really take a lot of dips. Instead, it just goes flat. And that is like the most beautiful strategy ever. Think about that for a moment. You're going to ride all the uptrends, but when it pulls back, you're just out, right? Pretty cool stuff. Any questions about that so far? Probably going to be some questions. Let's go ahead and open them up just for a minute. I want to make sure I have time to wrap up my last slides. Larry says, I hope you have a link so I can join this. I love it. Yeah, someone says, I see a lot of fake outs here in Apple, but I just showed you how to overcome those. Really, really cool. So lots of people saying this is, Heiken Ashi is way easier to see momentum. I appreciate that. All right, cool. Steven says 21 day, nice. It's the simple moving average, exactly. All right. Okay, cool. So you can do stocks or options. I trade both, but good questions. We'll have more time for Q&A here in a moment. Let's go and jump back to the slides, okay? So again, looking at the payday cycle strategy, this is just your basic form, which is buying the first green, selling the first red. But hey, I showed you how to improve this by multiples, right? We took our average gain from 1.84 up to over 3%, right? Which is pretty cool. So average days in a payday cycle. When I looked at the SPY, the Qs, and Apple, and I back tested the general standard payday cycle, we have a win length of 7 days. Why is that important to know? Well, if the SPY and the Qs and Apple and all these stocks have an average payday cycle of 7 days, that tells you so much about the natural cycles of the market. It's this magical number. The market tends to cycle on average about for 7 days. And this is something that's already occurring anyway. So why not jump on it? And I don't know about you, but when I buy the Qs, I'm not going to personally move the Qs around. I'm not trading $1 billion, right? So because I'm not moving the Qs around, and I look at the data, the Qs are already moving on their own, right? So I just want to ride that. I just want to ride that trend. And so I just wanted to highlight this for a moment because it's so important to know. Hey, the market cycles about every 7 days. That's just an important thing to know. Okay. So again, some of the key differences here between a candlestick chart and a Heiken Ashi chart. We got your candlestick chart, choppy, hard to read the trend. There's no clear cycles, hard to trade from. Heiken Ashi, smooth. It's easier to read the trends. It's very clear cycles and easier to trade from. So what are the best stocks to use for payday cycles? Let's take a look. So how about NVDA? NVDA actually has pretty darn good payday cycles. You can see how well it payday cycles here. Again, pretty good risk reward, about 1.8. Batting average is about 54%. Remember, we have not included any additional probability stacking here. We're just looking at the raw payday cycle data. You can always improve it, right? And this strategy is also outperforming buy and hold on NVDA. Netflix also has great payday cycles, risk reward over 2, which means your average gain is substantially larger than your average loss, and that overcompensates for a little bit lower than average batting average. The Qs, one of my favorite payday cycle ETFs, the Qs have an insanely good risk reward, a decent batting average at 54%. But the thing is, the Qs have been profitable trading payday cycles every year for 10 years. And that's important. Let's talk about the Qs for a moment. Again, every year for the last 10 years, the Qs with the very basic payday cycle, buying the first green, selling the first red, you can't get any simpler than that. It's been profitable every single year. Average gain, again, similar to Apple, right? A little under 2%, average loss under 1%. So you're keeping your losses small. Average win length, surprise, 7 days. Okay. Now, how do we use this information? So you can use the average win and average loss to help us gauge profitability and stop targets. So again, if you're trading a $200 ticker and you know the average gain is, just about 2% or just under, you're looking at about a $4 move, maybe a $5 move. So, hey, maybe you set a good till canceled limit order after you get in to sell 30% or 50% at $4 or $5 on the upside. That way, you don't even have to be at your computer. If it goes up, it's average gain, boom, you're out. You have some profits on the table. Average loss, right? You can use that for position sizing. If you have a $200 ticker, the average loss, let's say again, averaging is a negative 1%, you're risking about a $2 down move. If you buy 100 shares, you're risking $200, right? You could also use it if you're an options trader. This is really cool. Somebody asked about this earlier, to help choose the correct expiration and strike price. A good rule of thumb for expiration is to triple or quadruple the average length, which means if the average days is 7, 21 to 30 days should be more than enough time. Knowing that these cycles rarely last more than 10 days, you don't need to buy 6 months of time in your options to do a 7-day trade. And with average gain and average loss, again, you can use that for profitability and stop targets, but more importantly for position sizing. So if you were to buy 10 at the money calls, I'm going to throw out some Greeks here. I hope I don't lose people. If you buy 10 at the money calls, if they're at the money, they got a 50 delta. If you buy 10 of them, you got a 500 position delta. If you're trading a $200 ticker, and you got an average loss, let's say of 1%, we'll be conservative. You're looking at about a $2 down move. If you have 10 calls at the money with a 50 delta each, you have a 500 position delta. If you have a 500 position delta and your average loss is about a $2 down move, you're risking about $1,000. If you're not cool with risking $1,000, you're buying too many calls. So you can use this data to not only gauge profitability targets, gauge stop targets, help you identify expiration dates, but you can use it for position sizing, which I believe position sizing should be the first place where you manage risk. Absolutely the first place. But you can use this data. The big thing here is that you don't want to guess. You don't want to guess on this stuff. You don't want to guess with your money. Use and leverage the data so that you can make the educated decision on your trading. Cool? All right. So how many stocks do you need? For the most part, a lot of our people have personal transformations in their trading. They go from trying to trade 100 tickers or more to just trading 2 or 3 tickers that they know payday cycle really, really well. So I think that for the most part, a lot of people can get away with just trading 2 or 3 things. And hey, I mostly swing trade Apple. I got 1 ticker that I use. It gets me into a payday cycle once or twice a month, and that's perfect for me. Okay. I'm going to go ahead and take about 4 seconds and plug my laptop in. 1 sec. All right, and I'm back. I think that was under 4 seconds. How many trades a month do you need? For the most part, a lot of people with 5 or 6 trades a month, 2 or 3 stocks, that's going to be more than enough swing trades to get them cash flowing. How much time do you need to spend? Now, I really think that under 30 minutes a day, you should be able to do this. If you learn, and again, I've got this great masterclass I'll talk about here in a moment, but if you learn how to identify payday cycles, how to read the Heikin-Ashi chart, and how to trade just a few tickers, I mean, 30 minutes to an hour a day, it really shouldn't take you more time than that. If you're taking more time than that, you're probably maybe over-analyzing things, right? So what's possible using the payday cycle method? Here's a fun picture of me and my daughter, Jules. I used to struggle, and once I discovered this payday cycle method, I've been off to the races. The biggest thing here is you get to use defined buy and sell rules. I like the idea of being a specialist with a few stocks, not a generalist. It also just helps my brain not having to look at a million stocks. I like to trade by the numbers, which means I'm using this data to help generate my buy and sell. I'm also using it to help me identify profitability targets, everything that we just talked about, and I get to use the foundation of payday cycles for the swing trading. Okay. Some cool things that have happened to me since I've discovered this strategy a few years ago is I'm building my dream house here in Santa Barbara, California. Should be done in a few months. I get flown around the world now to teach this stuff. This was me teaching this to an options traders group in Phoenix. And I got to also meet some cool people. Probably a lot of people here know who this is. This is Tom Sosnoff. Really, really great guy. I got to visit the Tasty Trade studios, personally walk me around. I was not on the Tasty Trade show, which would have been cool, but I did get to visit the studios. I've been lucky enough to meet all these great people. And now I have the opportunity to help other people. So for example, here's one of my students, Marco. He was a break-even trader from California. His goal was simple. He wanted more consistency in his trading. His account was flat for many years in a row. He'd make money and then lose it. He was actually generous enough to send me a screenshot of his account. You can basically see. This is probably one of the most frustrating things a trader can go through. You make 10 grand, you lose 15 grand. You make 5 grand, you lose 2 grand. You make 20 grand, you lose 20 grand. This red arrow here is when he started to apply the payday cycle method, which is an actual strategy that can be applied over and over and over again. And it helped him break out and have a new profitability curve, a breakout in his profitability curve. In fact, he made over 120 grand in just 2 weeks trading Apple and Baba. Now, he didn't put like $100 in this trade and make 120. This is not like a get rich quick thing. This is by leveraging the strategy, you can create more consistency. The cool thing about Marco here is he now only trades a handful of stocks. He only trades, once or twice a month. So he's spending way less time in front of his screen and his consistency is way up. And that was a big shift that occurred for him when he started to use the payday cycle method. So here's Lisa. Lisa was a stay-at-home mom from California. Her goal was simple as well. She wanted to make more money from home while working part-time. Her struggle was she had a really hard time finding entries and exits, and she was jumping around strategies all over the place. By creating a routine with the payday cycle method, her first year she had an 86% batting average. And the result was we helped her grow her account her first year from 100 grand to $320,000, which was quite remarkable. And this year she's having her best year ever. She says, here's what Lisa says, before entering a trade, I always refer to my payday cycle charts inside of Wall Street AO. And so here's how I can help you. I've developed this amazing course called the Payday Cycle Masterclass. It's a 6-week course. This 6-week course is designed to help you create breakthrough results in your trading. So what do I mean by a breakthrough result? Is a breakthrough result turning 100 grand into 120 or 25 grand into 50 grand? I don't think so. I think that a breakthrough result is not just making more money, but it's how it impacts your life and your trading and your mindset and your daily routine. A breakthrough result would be going from like spending all day at your computer, slamming down on your keyboard, being super frustrated, not knowing what you're doing, being completely overwhelmed, to being, waking up, sipping on your coffee, being cool, calm, and collect, spending 30 minutes a day in front of your screen, only trading a few things and becoming more profitable. That's the breakthrough that we're looking for here. So I coached a student once who turned a $300,000 loss into a $500,000 gain. When he came to me, he was down 300 grand. This guy was like freaking out, right? Now, with the payday cycle method, we helped him develop a strategy inside of that to get his 300 grand back and turn it into a $500,000 gain. That was an $800,000 switch. This was not overnight, by the way. This took 18 months. So this is not a get rich quick thing. This is how to develop a strategy and a daily routine and apply it systematically over and over and over again and continue to milk it. So this was over a lot of trades. This was not like one trade, he bet the farm and made it all back. No, this is developing a strategy and a routine so that you can minimize risk, maximize gain, and develop it over time. So the Payday Cycle Masterclass is a $2,997 course. Well worth it, right? So I want to give you the Payday Cycle Masterclass as well as a few other things to help you today. I also want to give you our 90-day roadmap. The 90-day roadmap is what comes directly after the Payday Cycle class. So the Payday Cycle class gives you the foundation, but now you need to apply it into your life with a routine. So the 90-day roadmap gives you that. The whole goal is to get your trading down to about 30 minutes a day. And you do that by only trading a few stocks, and they're going to be the highest probability setups with those stocks. We're going to get you started with payday cycles and options trading if you choose to. We'll show you the best stocks to use, the best options. We'll actually give you our trade journal. The important thing here is that it creates accountability and lets you measure your success. It's really hard to improve if you're not measuring. Then you move to more advanced strategies and predictability, and then the world of profits. This is what the 90-day roadmap is. It's a $1,997 value. Okay. Of course, we want to give you the Wall Street IO platform. The Wall Street IO platform gives you daily email notifications for any strategy that you follow. So if you're on Wall Street IO and you load up a strategy, whether it's a payday cycle or whether you're here and you like the MACD or basically anything that you load up here in the backtester, if you like the results, you can click follow. You can see mine says unfollow because I've already followed the strategy. And the day that these conditions are met, our system will send you an email saying starting today with the strategy name, or ending today, or day 4 of strategy. Why is it important to know how many days you are in? Well, if you know that the strategy lasts on average 7 days, then it's a really good idea to know that you're on day 7, right? So our email notification tells you what day you're on as well. It's pretty cool. You also get unlimited backtesting, scanning, and charting. Inside of our platform, data is included. You'll get access to our alumni group of traders and live trade room. This is a 12-month access pass, $2,400 value for the Wall Street IO platform. Here's a quick highlight for our membership. Hey, Micah, it's Matt Webb. I want to thank you so much for providing an amazing platform for us. Since joining Wall Street IO, I've tripled my options account. And I've been constantly learning so much. Now, this is the important thing here. He didn't just say he made a ton more money, because that wasn't the breakthrough we were looking for. Yeah, he made more money. The breakthrough came because he's constantly learning so much. That's where the breakthrough happens, right? All right, 12-month access pass, $2,400. Here's the cool thing. I want to give everybody a bonus here today, and the bonus is going to come in the format of a weekly live coaching call. You're going to get access to live coaching via group webinar every week, every Monday at 2 p.m. Eastern time. I go live for an hour. If you can't make it live, we give you the replay. You'll get direct insight into how I'm seeing the market. It'll be live. You could ask me anything, and this is a $3,600 value. I literally set aside an hour of my time every week to help you. The reason I do it for a year and not just 2 weeks is because of this. When you first start, you're going to be down here, right? And you'll watch the Payday Cycle Masterclass, and you're going to accelerate really fast. And then you might have some questions, and you may plateau. There may be a question that you have that you didn't have in the beginning, right? And so you'll come to the live coaching call, you'll ask the question, I'll answer, and you'll accelerate again. And then, maybe 3 months from now, you'll have this other question like, oh my gosh, how do I delta hedge, or how do I manage, or some advanced question that you never even would have thought about in the beginning. And then I'll answer that question, you'll accelerate again. I'll be holding your hand throughout the entire year. And that's the whole point of doing this for a year. It's going to take time to get you up to speed, and you're going to have questions down the road that you're going to need answered. So I want to be there to help you and guide you through this process. All right, so Payday Cycle Masterclass, 90-day roadmap, 12-month access pass, and a bonus of a year of live coaching, $10,994 value. I want to give everybody an amazing deal today for just less than $2,000, right? Which I think is a good deal. However, even better, as my way of saying thank you for being here, we're going to give you a $1,000 off coupon if you sign up today, which means instead of $2,000, you're going to get all of this good stuff for under $1,000, only $997. Jeanette, if you could post the link, it's www.TradeThirsty.com, and I could actually put this in the chat as well. It's going to be Wall Street IO/TradeThirsty. And this is going to take you directly to the sign up page with the coupon, which is pretty cool. So, by the way, the $1,000 off coupon expires tomorrow at midnight. And again, it's www.wallstreetio/TradeThirsty. I posted the link up in the chat room. You can click the link. You're going to get access to all these goodies. And I've got a cool bonus for you today as well. For everybody who signs up in the next few minutes, we're going to give you a one-on-one strategy call with me. This is going to help you get through any roadblocks. You'll get 30 minutes with me. I can only give it to the first 5 people who sign up right now. So if you're interested in working with me one-on-one, go ahead and sign up right now, and you get a free strategy call with me. The cool part about that is we're going to develop a roadmap and a plan tailored to you. We're going to find out exactly where you're stuck, and I'll give you a personal walkthrough. You're going to get the same roadmap that I created with one of my students who turned that $300,000 loss into a $500,000 gain. The cool thing too is before we jump on a call, I'm going to send you our trader discovery sheet. And in that sheet, we're going to ask you questions like, how's your ability to gauge profit targets 1 through 10? How's your ability to manage trades 1 through 10? And you'll answer the questions twice, once for where you are now and once for where you want to be. And in doing so, I review that before our call so I know exactly where the gaps are in your trading and we can pinpoint them. It's not going to be a random broad stroke conversation about trading. We will literally pinpoint the exact areas based on the trader discovery sheet that you need help with so that we can have maximum impact for you. Now, I wish I could do this for everybody, but I simply can't. But for the first 5 people today, I'll give you a free strategy call. So if you sign up right now, I'll go ahead and I'll see that you signed up. And for the first 5 people, I'll send you a trader discovery sheet and you'll be able to get on my calendar immediately, like as in today, you will be on my calendar. Okay, so I've got a few minutes left here. I'm going to open this up for questions. I'm sure there are some. But if you want to sign up, you can go to www.wallstreet.io/TradeThirsty. It'll populate that $1,000 off coupon. You're going to get the PayDay Cycle Masterclass, our 90-day roadmap, a 12-month access pass to Wall Street AO, and a whole year of live coaching. And if you're one of the first 5 people to sign up, you will get a one-on-one strategy call with me, which I don't do very often because my time is very sacred. And of course, I can't do this with everybody. But if you're one of the first people to sign up today, I'll go ahead and give you some of my time personally to help you get started. Sound cool? Sound cool. All right, let's take a few questions. How we do it on time, by the way? Let's see.
You're all right. You got about 6 minutes.
Okay.
All right.
All right, cool. Questions. All right, any questions about getting started? We got the link up here. And by the way, if you sign up right now, go ahead and let me know. Let me know in the chat room. All right, we have a post. We have a post from CMS. He says, hey, by the way, I'm actually already a member. By the way, the scanner and the back tester is well worth the membership on its own. That's so cool to say. I really appreciate that. Maria says, wow, this is so cool. Gavin says, can you backtest shorter time frames? Right now we're backtesting the daily, mostly because our group is mostly swing traders. One of our goals, though, this year is to include intraday data for backtesting. It's a big project that our engineers are working on. For people who want to use this for day trading, again, we don't quite have intraday data yet, but we will have it soon. All right, good questions, everybody. All right, a couple of questions are, how much is data? So the cool part about that is data is actually included free. We don't charge anything extra for data. Another question comes in that says, how much is the next year? So the cool part is, instead of bumping you up next year and charging a few $1,000s for your membership, we're actually going to grandfather you in. So if you get in today at $997, you'll get the whole year. And if you'd like to stay another year, we're going to grandfather you in with the same discount. Cool? Does that work? Question, are you using the 20-day simple or exponential? We're just using the simple. All right. Let's see, I'm going to answer this. All right, good questions. Any other things? Just looking through the questions right now. Looks like we covered, for the most part, a lot of them. A couple questions about entering on the second candle. You know, from time to time you can, but again, you're taking a little bit more risk by getting in late, and so you have to accommodate it for that. And maybe that just means simply taking a smaller position. All right, cool. So one of my last questions for the group today, because it looks like we've got a bunch of people who have signed up. I think we have 2 spots left on the one-on-one. And if you just signed up, by the way, please let me know so that I could highlight you and acknowledge you for signing up. My question for the group is, what has been the biggest takeaway or highlight for you today? What have you learned that is going to make a big impact for you? Is it backtesting? You may have not known, because we're the only ones who do this that allow people to actually backtest like this. It was a backtesting. Was it PayDay cycles and understanding cycles? Was it going through the statistics of stochastics versus MACD versus PayDay cycle and seeing that the PayDay cycle was clearly the huge winner? Go ahead and let me know what the big highlights were for you today. All right, so I've got a couple of people who have signed up. What I would recommend you do as soon as you sign up, obviously, I'll send you the trader discovery sheet. But what I would do is I'd go right into the university by clicking right here. I'd scroll down until you see the PayDay Cycle Masterclass. Inside the PayDay Cycle Masterclass, this is where you're going to get started right away. Some of the really important lessons are lesson number 3, which is all about probability stacking, and lesson number 4, the success framework. These are going to help you position size. It's going to give you examples for using stock and option trading. It's going to help you get started really fast. In under a couple hours, you're going to be able to bust through this whole course, and you'll be up and running super quick. So what I'd recommend immediately, as soon as you sign up, check out the PayDay Cycle Masterclass. Once you've completed that, you can watch our Getting Started guys. We have some really great videos. These are really short, by the way. These are only about 1 to 2 minutes each, and these are going to walk you through every single feature on our platform. Okay? And you can check them out. There's about 14 of them that go through all of it. Once you do that, you're going to be up and running on our charts, on our backtesting, on doing PayDay cycles. It'll walk you through how to get notifications on the strategies, everything you basically need to get started. Pretty cool? Good stuff. All right, Mark says, good stuff. All right, cool. Mark, we'd love to see you as part of our group. William says, aren't you getting late if you wait for the 21-day? So you're getting in on the new PayDay cycle after the 21-day. So you're not just waiting for it to go over the 21-day, because maybe it could be the fifth one, the 5th green one, that, right? You don't want to get it on the 5th one. So once it's above the 21-day, wait for the next one to start. Stanley says the PayDay cycle looks awesome. Kevin says toss. I'm not sure what you mean by that, but toss is thinkorswim. The disadvantage of toss is that it doesn't give you any performance on the strategy, so they're kind of relying on you to guess, which obviously doesn't work. Yillian says big highlight today was knowing the trend and avoiding the fake outs. Cool, really cool. All right, great questions, everybody. I think that's pretty much it. Does it work for down markets? Absolutely. We actually created the ability to backtest short strategies as well, simply by clicking on short. William says, gotcha. Okay, cool. All right, cool. I think my time is up. So I really appreciate everybody being here today. Hope you learned a ton. I'm going to turn this back over to Jeanette. If you sign up right now, again, I think there's 1 spot left for the free strategy call. I look forward to working with everybody here, and I hope you learned a ton.